Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back and kick up your feet because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Hello, Lower Alabama. Hello, Gulf Coast. Welcome to Coasting in Retirement. That's right. Thanks for joining us today. We have another great show coming your way. Josh Knoll here. I'm joined by regular co-host and show sponsor, Mr. Jay Stubbs with Providence Partners. Jay, how you doing?
Josh, I'm doing great. It's good to be with you here in studio during what appears to be spring break because we were able to get a parking spot.
Yes.
And, here at Gulf Coast Community College, great to be in their sound room. Glad somebody able to let us in since classes are not going away.
Coastal College's beautiful downtown Fairhope, which is always a street fight to get parking. You're right. So back here, we're ready to put together another great show for those of you tuning in. Listeners, Jay and I are here today to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. Here's what we got in store. First segment, deep dive on our topic of the day. Second segment, roughly 30 minutes past the hour. It's called Headlines of the Week. And then roughly 50-ish minutes past the hour, stick around for our third segment. We call it Josh's Crystal Ball and Big Mouth. And we got some pretty important predictions to talk about. Quick background on me for those of you new to the show. Again, my name is Josh Knoll. I'm a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That is a 100% independent, 100% locally owned, independent investment management and financial planning firm. We have offices in Fairhope, Orange Beach, and Mobile. You can find more information on me and the team at Gulf Coast Financial Advisors by visiting our website, gulfcoastfa.com, or give us a call anytime, 251-327-2124. If you just missed that contact info, grab a pen, grab some paper. We're going to repeat it several times throughout the show. All right, Jay, I'm going to do a little groundwork for our listeners before we get to our topic of the day, okay?
Okay, sounds good, Josh.
Yeah, especially for our newer listeners. And I want you all to pay attention to this term. This is going to be important to how we stitch our topic together today. The term is called family office. Now, family office in our industry, financial planning, financial services, wealth management, investment management, it is an important term, and it's a trend that is happening across the industry, especially wealth management. So let me define it for you all. A family office is a private wealth management advisory firm that typically serves ultra-high net worth individuals. Typically managing, those clients have at least 20, 30 plus million in assets. The family office provides comprehensive services such as investment management, estate planning, philanthropy, lifestyle concierge services. The goal to help manage and transfer wealth across generations. Beyond that, there's education for the heirs. There's lifestyle management. The overall goal is to offer holistic, personalized, and centralized oversight of a family's entire financial life, often acting as a personal financial headquarters. That was AI-generated definition. Do you agree with anything to add to that, Jay?
I 100% agree with it, Josh. And they're not new. For those of you listening at home or driving down the road, family offices, especially in the major metropolitan areas like a New York City or a Boston or a West Coast LA, they've been around for 10, 15 years. We used to, back in my day of sales directing and running as the risk management consultant for the Gulf Coast for protective life insurance, we would try to get into family offices in the larger metropolitan areas because you have a seat at the table, so to speak. When that advisor is sitting with those clients and they determine, yes, you need some life insurance here, you need some life insurance there, whether it's family, estate, legacy, or business, we were had a seat at the table. But they have been around for quite a while, but they're just now starting to become what I would say in vogue in communities like ours along the Gulf Coast.
Well, and there's a reason I bring it up, Jay, because effectively what we have built at Gulf Coast Financial Advisors is what you would call an outsourced family office, or a hybrid, if you will. Now, the primary difference compared to the definition I just gave to you all, that instead of only serving those of you with 30 million plus in assets, which we do have clients with large amounts of assets, but we also intentionally help regular people that have done extraordinary things. So having built an outsourced version of a family office, for those of you that in our industry, because we have to label everything, you're called mass affluent or you call it a high net worth individual as opposed to an ultra high net worth individual. If you're mass affluent, if you're high net worth, if you're, quote unquote, a regular investor, a retail investor, often you don't get this level of family office service with your typical financial advisor, especially any of you out there that are still hanging with an old school broker. So I wanted to talk about how we do it.
Another one that a lot of people listening might be is a Henry. Have you ever heard of a Henry?
I have not.
All right. A Henry, and you'll chuckle if you're listening to this driving down the road, is I've got a good job. I'm a Henry. I'm a high earner, not rich yet.
Yes. Okay.
I haven't hit that moment where I can walk around and just do whatever I want because I've got money to do whatever I want. I'm a high earner. I've got a good job. But I still have bills to pay, mortgage to take care of, insurances to take care of, kids in school, headed to college. We make a lot of money, but at the end of the month or at the end of the quarter, we're like, God, where did it all go? We're making good high earning livings, but we're living the lifestyle, but we're just not rich yet because we have expenses. We have life.
Well, and sometimes you're coming out, a young doctor would be a good example of a Henry.
A perfect example.
Right. They've kind of suffered through all the school, all the college, the doctorate, the residency, and they're going from an environment where a lot of times people are coming into that type of life. They want to help other people, but they don't necessarily have a ton of money coming in. And it takes a while, but then all of a sudden, boom, a lot of times you get this high income and you become a Henry right off the bat. Well, there's a reason I bring it up, Jay, because this is how we do it at Gulf Coast Financial Advisors. So by definition, let's be clear here. We are not technically a family office. What I'm telling you is, while we provide sophisticated investment management services, and that is very important to your overall financial success in retirement, we always lead with financial planning. And under our financial planning umbrella, this is where the family office component comes into play. We work hand in hand with incredible and fantastic strategic local partners. For example, we have them help handle our clients' estate planning needs. That's a family office type of activity. Their tax planning needs. That is a huge thing in today's world. Their legacy planning, especially for those of y'all that are thinking about transferring wealth to the next generation. We help with financial education. This show is one example of that. And to the specific point of this episode, we use our years of experience and a key critical strategic partnership to help our clients with any risk management needs, particularly around life insurance, long-term care insurance, and disability income insurance, which regular listeners are saying ding, ding, ding. That leads us to Jay Stubbs. So Jay, would you mind to lay out what you and Providence Partners do not only to assist Gulf Coast Financial Advisors clients with these things, but also many other independent and semi-independent advisors along the Gulf Coast? The floor is yours, my friend.
Yeah, so thanks, Josh. It gives us the opportunity to be a strategic consultant to you, to other types of firms, property and casualty agencies, other wealth advisors along the Gulf Coast, up and down the state, in the Southeast. We are the risk management consultant outsourced by you, by your firm, that says, hey, I've uncovered a client. They've got questions about life. They've got questions about long-term care, or they need to protect their income. Instead of, Josh, you getting into the minutia of those details, because it's a lot to digest.
Right.
You've got to do a lot of data gathering and field underwriting and figure out what's going to be the right product, solution, company. Sometimes there are lots of good fits, and you want to narrow that down and narrow your focus. That's where you say, hey, we outsource that to a strategic consultant. What Providence Partners is a boutique risk planning agency that you are our client, Josh. Mm-hmm. People like you, financial advisors, insurance professionals, wealth advisors, RIAs, IARs, which is investment advisor representatives. If they mainly day-to-day deal with other components of financial world, i.e. investing and trading and planning, but then the risk component comes up, they want to have somebody at the table that understands that and can speak that language clearly to the client. So that's what we do at Providence Partners. We represent A-rated companies in all aspects of life insurance, long-term care, disability income protection. That also brings into light, we offer guaranteed products like annuities. So we look at multi-year guaranteed annuities, income annuities, because those are offered by insurance products. And as a resource to you, the wealth advisor, financial advisor, that gives you the confidence in knowing, hey, between Jay and his team, I've got over 100 years of experience between all of the people that support these financial advisors, support me in my day-to-day operations. And I have the confidence that if I ask them a question, they're going to give me exactly what I'm looking for. They're going to help that client make a decision and ultimately go to the transaction of the process and help that process flow. You know, when somebody says, Josh, I'm ready to do that $5 million 20-year term to protect that line of credit that we just got from my business. Well, what are the hoops that we've got to jump through for that? There are several. Sometimes if the guy or lady is extremely healthy, we don't have as many hoops to jump through, but we still have to start an application process. We have to go through an approval with an underwriter at a specific company. Then we have to get a policy issued based on the parameters that policy needs to be designed, and then we need to place that policy in force and then manage and monitor that policy as it moves down the road. So lots of things that you, Josh, have said in your last couple of years, I don't want to deal with that because I don't deal with it every day. I'm just going to bring in Jay as a strategic consultant, and you've chosen that, and we are thankful for the partnership we have at Providence Partners and Gulf Coast Financial Advisors because it helps both of us.
Well, and like you said, the one of the things is not only we're doing show prep, and I was complaining and whining a little bit to you about the fire hose I was having to drink from of information around some compliance issues that I'm learning as we're going along. Same thing with your industry. Things are changing so much, and there's so much data to keep track of that I think if someone tried to be the jack of all trades in a family office type of setting, or at least one that is trying to emulate an outsourced family office, man, you're going to be missing details left and right. Because as we segue into our main topic of the day, Jay, one part of your industry, all parts of your industry, but specifically one part of your industry is undergoing monumental generational change in this moment. And what I'm referring to is life insurance. So as I was putting together the show outline last night, I got to thinking, based on some of the feedback you had been giving me lately, a question popped in my head. With all of the tech going on and all the changes, and artificial intelligence and everything, the simple question, and what we're going to try to answer today is: has life insurance ever been easier to get than right now? So that's my question to you.
Well, I think the question which you asked me specifically was, is it now easier to get life insurance than it ever has been in the past?
There you go. That's a better way to put it.
So yes, the answer is yes. It is easier now, and I'm going to give you the easy reason.
Okay.
And that's technology and has created the process and made the process much more efficient.
And eliminated paper, if nothing else.
Absolutely.
Right. Okay.
Gone
Gone
are the days of having to go into the agency or sit down and fill out a whole 50 pages of pen and ink, scratch throughs, rewrites. We missed a signature. That's gone. We can still do the paper versions. They just take so longer. But technology has created the process of efficiency, and the insurance companies have gotten more lenient, Josh, on health histories that used to be roadblocks in the past. And that to me is huge. We had a special session with one of our insurance companies yesterday that came to Mobile and did an educational event, Lincoln Financial. They're just one of the A-rated carriers we represent. They wanted to promote their products and say, hey, give us a shot at earning your business. I was surprised. They could give two hoots on whether or not somebody uses marijuana or not.
Really?
THC, gummies.
No big deal.
No big deal. The stuff in the drinks, as long as you say, hey, yeah, I'm a recreational user, a couple times, 3 times a month, they don't care. You can get preferred plus.
Yeah, listeners used to be treated at best as a smoker. And that was even if you got to that point. Usually you were denied.
Another thing that they don't really care about anymore is specific cancer from relatives, mom, dad, brother, sister.
Family history.
So it used to be, like my mom died of cancer prior to age 60. It used to be that I was automatically knocked out of preferred best because she died of cancer prior to age 60.
Right.
Lincoln doesn't, and they're just one of these companies, Lincoln doesn't even ask the cancer. They don't care. They'll ask, yes, but they don't care if any of your mom, dad, brother, sister died of cancer prior to age 60. They just want to know about more the cardio, the stuff that's current, cardiovascular, the diabetic, cholesterol, blood pressure stuff. But cancer, they're saying, you know what? We're so far advanced in treating cancer, and I agree with that. Medical technologies and therapies and treatments, we're so far advanced in that world that it's not that big of a concern to the insurance companies. If you are diagnosed, yes, caught early, gone through treatment, and are now in remission, then you can still qualify as preferred best. Amazing to me.
That is amazing.
So technology making the processes easier and more efficient, companies being more lenient on health history, both you and your family, and then looking at the rates of how long people are living. That's the mortality cost.
Right.
We don't want to get into the minutia of how insurance companies price their products, but it's basically the lowest cost per thousand it's ever been, because we as a society, no matter where you live in the country, we are living longer because of medical technology. And when people live longer, that means the mortality tables have a longer span of life for both males and females. And when you break it down to cost, now you've got something that's very affordable. You've got something that you can still get really good rates, even with your health history. And you've got something that doesn't take very long because of the technology in the process.
Is this the volume?
That to me is game changing.
Game changing. I mean, the volume of data now that they have to analyze around this, that's got to be a significant game changer, because, you and I, you've been doing this. See, I've been 17 years, close to it. You've been 25,
27.
27. My gosh. I mean, we came up when it wasn't exactly hammer and chisel into stone, but it wasn't far off. And you're tossing it over to the wall into this black box of underwriting, which was the bane of our existence, let's be honest, back in the day.
Absolutely.
You're like, oh my gosh, did this guy's broken toe 10 years ago going to knock him out? What's going on here? But, and to be fair to those actuaries, a lot of good underwriters, but they had a limited data set as well now.
Yeah.
So what you're telling me is just the volume of information, you've got the combination of all the data that they can pull from with the fact that we are living longer. Now, you can make an argument we may not necessarily be living better, but we are absolutely mathematically living longer, which is what life insurance is looking at. Life insurance doesn't pay, typically if you get really, really sick, it pays if you pass. So they're worried about you dying. So all that together, in 2026 and beyond, what you're telling me is that for a lot of people that maybe haven't looked at applying for life insurance in the last 3, 4, 5 years, might be time because of something in their health history, might be time to take another look.
Absolutely time to take another look. We can do an informal inquiry, a review of your health history. It doesn't cost you a dime. We have questionnaires specific to your ailments. We can get that data reviewed in a matter of a day and have informal offers from insurance companies, which is amazing. The data that they gather when you start the formal process it moves really, really quickly. Again, they're pulling Medical Information Bureau reports. They're pulling prescription history reports. They're pulling MVRs, motor vehicle reports, and they're doing that with your permission, of course, because when you say electronically, yes, insurance company, you can go grab my stuff, they're going and looking out there, and if they don't see anything, and then you answer some of the cursory health information as no's across the board, the likelihood of approval, even with maybe a little bit of minor stuff in the background, the likelihood of approval at a really good rate class in a matter of hours, minutes, sometimes days, just depends on what kind of history we've got to deal with. But efficiency has been there. And I also want to point this out, Josh. It's something has changed over the last, I don't know if it's post-COVID or if it's just a different generation now kind of moving into the driver's seat when you start looking about, Gen X, baby boomers, we know where you are. Then there's Gen X, then there's millennials, and then there's Gen Z. Well, something is clicking among the Gen X and the millennials where risk protection is in vogue. There is a
They drink less too.
There's a greater demand for people saying, you know what?
Maybe they drink normal and Gen X drank too much. Sorry.
It could be. But the point I'm trying to make is they understand the importance of protecting their income when they get a good job with good paying month-to-month income coming in. They want to make sure that paycheck is protected with disability income protection. They understand the importance of a life insurance policy. Now, a lot of that has to do with some of the marketing that's going on. I think we're going to talk about it here in just a little bit.
We are.
That's big time on TV, big time on radio, big time online. When you're scrolling through, you'll see this based on your demographic. It's important. They understand the importance of risk management protection. There's probably some baby boomers listening to this show, driving down the road or walking around the house, be like, you know what? I just needed insurance while the kids were at home.
Right.
A lot of people now are saying, I need that insurance, but I also need to cover this business line of credit. I need to make sure that I have some sort of final expense policy, something that's going to be there to take care of things when I eventually do pass. And maybe I want to leave something to my kids, legacy plan, transfer of wealth, life insurance is the most efficient way to transfer wealth to the next generation. If you're listening to that and say, I'm thinking about that, let us have a conversation with you, because it's very inexpensive, and rate classes probably are not what you think they used to be based on your health history.
Well, and too, Jay, I was going back down memory lane. I think it was 7, 8-ish years ago when you and I never forget, in our previous podcast, we were all excited to talk about no exam issue, simplified issue, whatever, $1 million coverage. You remember that?
Yeah, I do.
And that's probably the norm now.
Well,
where you could apply for a large amount of coverage and get it instantly issued without the nurse coming and sticking you 5 times trying to find a vein.
$1 million has now turned into a couple of companies saying we'll go up to 5.
Oh, wow.
5 million, no blood, no urine, no exams. That's what we call a fluidless underwriting. Just answer these health history questions. Let us grab your electronic data that I just mentioned, MIB, prescription history, and MVR. And if all that looks clear, we'll auto issue a policy with respectable companies, A+ rated companies, in a matter of a few hours. This was never heard of.
Yeah, it was never heard of. And it seems like yesterday we were announcing that.
Professional athletes, auto buying, no questions asked, up to $10 million. Business owners who said, I had a really good physical. Maybe you're an executive for a company. Maybe you work for one of our larger organizations along the Gulf Coast, and they'd make you do a physical for your executive health. Insurance companies allow those physicals to be used for the underwriting for those business owners or business executives' policies. It's amazing.
It is amazing. Well, speaking of announcements, I know that you've got a somewhat fresh partnership you'd like to talk about that combines this tech and underwriting and ease of use, and it's called Ethos. Okay, I'm going to give you the table for Ethos.
Yeah, so if you're driving around listening, you may have heard Ethos Insurance. If you're walking around at home, you can sit down and Google this real quick. Ethos is a digital insurance agency that is nationwide, offering fast, 100% online term and whole life insurance policies without medical exams, relying on the health questionnaires instead. So you go through a series of easily understood questions, Josh, not very detailed, intricate questions. Easily understood questions, yes or no. If there's any yeses, you provide a little bit of detail. If you provide a no, then it moves on to the next question. Okay. It's been around since about 10 years, oddly enough. It's founded in 2016. What Ethos is a middle agency for what we call the top-rated companies, and they target a simple application process that provides coverage in minutes to U.S. residents if you're in between the age of 20 and 85.
How we doing?
Now, the target is 20 to 50.
Okay.
Because most 51 to 59, 60-year-olds, they've had something going on. Hell, a little
Exhibit A.
A little.
Why are you looking at me like that?
Yeah, a little something needs to be in. Got a little elevation in the blood pressure, a little elevation in the cholesterol. Ethos will still go through the process with you. It's just that you might need a more consultative approach, and that's where we come in at Providence Partners. We're still there to be your consultant, your live in-person resource for the risk management. But if you really wanted an online process that's purely digital and wanted answers in minutes up to $2 million, you've got it in us. So we partnered with Ethos. We are a Ethos agency here along the Gulf Coast. Providence Partners allows for that. So, Josh, you have access to the Ethos platform. You and your clients would. Anybody listening can go to our Ethos link and do all of this their own. When they do see the Ethos link, they'll see my name, J Stubbs CLU, which is Chartered Life Underwriter, knowing that there's a specialist that they can call and ask questions. And when they choose to do this, and a lot of people are choosing to do it because of the efficiencies, it's no medical exam. Only answer the health questions rather than taking those blood tests or those medical exams. Fast coverage. You can actually get completed online in minutes, and you can have a same-day policy. Same-day policy. You can get term life. You can get whole life. You can get guaranteed issue. If you do have some health hiccups, they'll just go ahead and offer you a guaranteed issue whole life policy right there on the spot. It's great for the quick business line of credit coverage that you just got approved at the bank. It's great for the, oh, goodness, we've got a kid on the way. Let's get this taken care of. I don't want to be the dad or the mom that didn't have life insurance. Just use it to replace the traditional, slow, paper-heavy process that sometimes people are like, I don't want to do that, Josh.
That's right.
I remember my dad complaining when he got his policy that the agent was sitting at his kitchen table for an hour.
Yeah, well, at least.
We're done with that.
Well, we're going to put the link to Ethos up on the website under your profile. So, folks, if you're listening to this, you can go to gulfcoastfa.com, go to strategic partnerships, look for Jay, and you'll have his ethos link there on there. Okay.
Yeah, and you can also, if you're saying, hey, what does Providence do again? If you're that type of advisor or agent that's listening to this, go to providencepartners.org. We are a dues-paying subscription service to you, Josh, with Gulf Coast Financial Advisors. That partnership has been in the works for years. We appreciate that, but we don't work with only Josh. We work with everybody. So if you're interested in what Providence Partners does, go check us out at providencepartners.org. And there you will also find the instant term life link. And if you are somebody listening that says, hey, I want to get that ethos link, I'm a licensed agent, yes, we can provide that to you. That is one of the offers our agency makes here along the Gulf Coast and in the state of Alabama and the Southeast, is you too can offer ethos for your clients through us.
Very good. All right, well, listeners, if you want to set a follow-up conversation with the team at Gulf Coast Financial Advisors, it's very easy. Give us a call, 251-327-2124, or find us on the website, gulfcoastfa.com. That's FA as in financial advisor. On the site, click on the blue button in the upper right-hand corner. That will put a meeting on my calendar. There's 3 flexible choices for a meeting. You can be as simple as a 15-minute introductory phone call. It can be a 30-minute Zoom, or my preference, an in-person 1 hour, complimentary, no cost, no nonsense, any of our 3 office locations. That's downtown Fairhope. We have an office in Orange Beach, just down the road from the wharf. And then we have a 3rd office in Mobile, actually right next to Jay's. It's near the intersection of Dolphin Street and I-65. However you reach out to us, make sure you do. We'd love to meet with you. All right, folks. Oh, one more thing.
I just want to say this.
Yeah.
If anybody does take action on the ethos link,
yes,
let you know, Josh.
Oh, 100%.
So, like, hey, don't be driving down the road or walking around saying, I'm going to go do that. And just let us know. Let Josh know.
Well, we need to put a tag on there that's a Josh promo code or something.
We'll figure it out.
All right, we'll figure it out. All right, folks, coming up next, there's always a lot going on in the world, particularly the world of finance, investments, and money. Every week we scour the internet for financial articles that have important information for those of you in or near retirement. Join us after the break to hear Jay and I discuss this week's relevant news in our Headlines of the Week segment. Stay tuned.
A multidimensional financial services company, Providence Partners serves the needs of independent insurance, financial, and employee benefit professionals. The team at Providence Partners serves other business professionals like property and casualty agencies, registered investment advisors, community banks, and benefit brokers to assist in their clients' risk management planning. Whether an individual or business owner client, this planning includes income replacement protection, planning for extended healthcare costs, family needs, and generational transfers of wealth. At Providence Partners, we give you access to industry specialists. Those specialists focus on business succession, business owner planning, family and household protection, estate planning, planning for that income loss, or planning for long-term care solutions. Providence Partners is an Alabama-based company. We have offices in Birmingham and along the Gulf Coast. Our website is providencepartners.org, and you can reach us any of the working days.
Welcome back to Coasting in Retirement. Your host, Josh Null, here. So, as we discussed before the break, every week we scour the internet for financial articles that pertain to those of you in or near retirement. Our job, or at least we tell ourselves it is to help you all understand how these headlines impact you, especially when it comes to your money. Now, quick note, if you want to read our referenced articles yourself, we do include the hyperlinks in our show transcript, which you can find on the website, gulfcoastfa.com. Just go to the podcast tab and then go find the episode that you want to re-listen to, and there'll be a transcript with all the article links. We try anyway to do non-paywalled and what we consider news sources that call balls and strikes. But anyway, with all that said and without further ado, Jay, let's get at it with Headlines of the Week. Are you ready?
I'm ready.
All right. So with the war in Iran suddenly resulting in quite a bit of recent stock market volatility and fear, Jay, I wanted to pull an article that addressed investors' concerns around a potential, what some would claim is a looming stock market crash. So what I found was on Morningstar, it's very recent article titled, "What We've Learned from 150 Years of Stock Market Crashes." So in this article, Morningstar identifies 19 major market crashes, which is defined very simply as a 20% drop or more since 1871. The big takeaway from this is despite 19 different quote-unquote world-ending events, which some were called that, some weren't, anything from the Great Depression to the World Wars to the 2020 COVID pandemic, the market has recovered 100% of the time and has always eventually gone on to new highs. One thing, though, that I found interesting was that in that whole conversation, Jay, was what they called the pain index. They didn't just look at how far the market fell. They looked at the area and the time between the peak and the recovery. Or in other words, a combination of the depth of the drop with the duration of the recovery equals the pain index. So, for example, the COVID crash of 2020, which was what, March, April, that was incredibly sharp. I mean, just bottom fell out, right? But 20%, I'd say it's way over 20%. But the recovery was so fast, 4 months or less, that on the pain index scale of the 19 crashes in the stock market history, that was graded as the least painful crash, which in the moment you wouldn't have known that, right? We thought the world was coming to an end.
Absolutely, we did.
Right. So compare that to
I was stocking up, gold as much as you see I can find. Do we have any gold left in the safety deposit box?
I was, full disclosure, I was walking around downtown Fairhope by myself making videos of what it looked like like the zombies had invaded. There was no one there.
Yeah.
And that lasted, honestly, about a week, and then everybody came back, if we're being fair. Anyway, compare that to the lost decade of the 2000s, so from 2000 really all the way to 2013, when it took over 12 years for investors just to get back to even. That's the kind of pain that can really derail a retirement if you don't have a plan. So this is where financial planning and risk management becomes so important, so that investors don't feel compelled to sell when the pain index is so high. So Jay, landing this plane, how do you help advisors help their clients while navigating volatile markets like the ones we're experiencing right now, which is honestly seems like all anybody wants to talk about? So what do you do?
So the first thing I'll say is it's client specific, Josh. How close is that client getting to the point where their income is going to stop, whether through retirement or selling out the business, transitioning it to the next generation? At what point are they going to start needing to make significant changes? You and I have talked ad nauseum, for the last several years about the retirement red zone. And to me, that's anybody that's within 4 or 5 years of actually saying, I'm about to stop this job and move on to something else. Our good friend Cam Larson says there's the retirement numbers part of it, and then there's the emotional, physical, health, and social component of it. So back to the retirement numbers part of it, we will consult with advisors and tell them, ask your client, how far away are they? Are they within 2 or 3 years? Because they need to start making some significant changes if they've been in aggressive growth portfolios and they're about to start needing to mitigate the risk of the ups and downs and volatility of the market. That's just natural. You need to move from something that's more aggressive to slightly more conservative the closer you get to retirement, because you want to manage those dollars.
Or hedge your risk.
Correct. You want to manage that risk, hedge that risk, so that you always can say, I've got an asset here to pull from and generate income to pay my bills in my later years.
Yeah, very
so
good.
I just say it depends. The pain index for a 25-year-old is...
They should really not have one, if we're being honest.
It's really, really high.
Because, I mean, honestly, and I think that for the most part, society, you were talking about the difference in generations.
Yeah.
Definitely the younger generation is risk averse, but they've been heard all the time that, hey, when the market is just screaming up and up and up, that's not necessarily the best time for you.
Right.
That's great for the people that already have the investments. The great opportunity for you is when the market dumps out, especially if it dumps out emotionally.
And that 25-year-old that was born in 2001.
Yep.
It's 2026.
Wow. Yes,
right?
You're right.
The 25-year-old that might be listening to this, or even the 35-year-old that was born in 1991, understands the potentially, you might have to go Google it or what have you, but the lost decade you referenced, the 2000 to 2010, really 2013, they might remember some pension and some saving that was going on at the house at that time.
Yes.
And, was it drastic? No, but there was certainly this uneasy feeling of we're not capturing the gains in the market like we should. And it's just, because everything was flat from 2000 to that 2010, 11, 12, everything in the market, when you look at it for total return, was flat.
Well, it's one of those rare decades where you had two significant market corrections in the same 10-year period.
Absolutely.
And it's fun, Jay, closing this article out, if you all click the link, there's a really nice chart that shows the market S&P 500 performance. Now, of course, I'm not sure if the S&P 500 was around in 1870s, but they probably extrapolated it out. Point being, it shows the market going up and to the right over that time period over the last 150 years, and it shows where you had I didn't know that the enforcement of the Sherman Act resulted in a market dip. Did you?
No.
The cornering of the Northern Pacific Didn't know. So it's interesting to see the different ones. Now, of course, what has happened after we came off the gold standard is you really start seeing this thing, volatility start really going. Had a pretty good run through the 80s and, of course, like we discussed, in the 90s even, the lost decade. But the point of all that is $1, again, at the S&P 500, $1 invested in 1870 would be worth over $35,000 today, even with all of these, ups and downs. You got the Great Depression in there. You got all this stuff, right? So the thing is, to reinforce what Jay said, is it does depend on your individual circumstances, what's going on right now. The one thing you don't want to do is listen to the talking heads too much on TV that are telling you to overreact one way or the other.
Yeah.
This is not the time to sell everything and put it all in gold. Don't do that. Don't do things drastic. This is time to have a conversation with somebody that's been around long enough and has enough education and life experience to have been through some of these. In my own case, I went through it. Jay was talking about the 2000s. Hello, I was in real estate then. So have somebody that's been through this stuff and can help you be your guide as we navigate this volatility. So very good. Jay, I'm going to stay on the volatility because, again, that's kind of the what's on top of mind for most people. This one's a little bit more in the moment, not looking backwards, around stock market jitters. It's on the Charles Schwab site. It's simply called The Ups and Downs of Stock Market Volatility. The article points out something that most investors forget. Since 1974, the S&P 500 has seen an average intra-year drop. So during the year, they've seen intra-year drops of about 14%, yet the S&P 500 is still finished in positive returns for 33 of the last 50 years, okay? Schwab's data also shows that timing the market is hard to do because the market's best days often occur within just a few days of the worst ones. They're never when you expect them. We talked about COVID earlier. We had all kind of buckled in a little bit, thinking it was going to be a rough ride for a while, and then all of a sudden you got this. I didn't know it was coming. Maybe if I'd been more politically astute then, but you got this tidal wave of trillions of dollars flooded into the market, and it wanted to go somewhere. And buddy, let me tell you, it went into the market, a big chunk of it. So, here's the thing, folks. If an investor misses out on just 20 of the best market performing days over the last 20 years, their total return over that time period would be 70% lower than if they had just stayed put.
Wow.
And I know that just sounds so easy coming out of our mouths, right? But seriously, Jay, for people entering in retirement, especially those looking to retire this year, this volatility and uncertainty is unsettling. So what do you think you and I can do to help them address those fears? We can give them the hard facts. Like, hey, if you can just ride this out, that's great. But you also have, you've mentioned it many times, you've got people, in the retirement red zone, 5 years or less, 1 year or less. They're wanting to know, hey, what can we do if I'm just trying to, on one end, I'm going to put the money under a mattress. On the other end, I'm going to just put my head in the sand and let this broker guy put me in 100% stock portfolio. Where's our balance in between, and how much does financial planning and risk management play into that balance?
Well, then I start asking the questions, Josh, let's educate the consumer, the client, the prospect on current interest rate environment, and let's have the conversation and educate them on what is deemed to be a guaranteed rate of return.
Okay.
That's really the only thing you really can do. If I'm too scared to shoot for the 10, 15% returns in the equity market, but I understand that I can't just let my money sit idle and not do anything work for me.
Yeah, it'll lose too much purchasing power.
I need to find some alternative, some middle ground that gives me peace of mind, but also gives me some growth, and that's a multi-year guaranteed annuity.
Okay.
And you know as well as I do, these are very strong offered products. We offer them through our agency, anywhere from 3 years to 10 years. We see a huge amount of folks that are uneasy about the market. I'm just going to take this money out of the market on the sidelines for a little while, and let me offer 5.7% multi-year guaranteed annuity compound interest, and gives you the access to get 10% free withdrawals from that. So if somebody comes in and says, Josh, I understand I'm uneasy about the market. Thank you for the education. This volatility is making me uneasy, but I need to get some sort of return. And then you say, you know what? I agree. Let's repurpose a little bit of your money towards a MYGA.
Understood. Very good.
That's what I would come in and offer as a solution right off the bat.
All right. Yeah, and MYGAs are not, I know they're not insured by FDIC, but for people to get their head around it, it's kind of the insurance industry's version of a bank CD to some degree.
Exactly right. Now, in the state of Alabama, there's you have the consumer protection funds for both life insurance and annuities, which is $250,000. So you're always protected. Gone are the days of these insurance and annuity companies failing like they did back in the 1980s because they were running on high interest rate assumptions that we never really got.
You're right. Right. Yeah, you had illustrations showing 12% interest forever.
As long as you're with an A minus, A plus rated company, even some B plus rated companies have good MIGA rates.
Right.
We do that research for you. We can offer A plus plus all the way down to the higher the rating of the company, sometimes the lesser rate they offer because I know that you're looking for the gold standard. But if you're comfortable, our agency is comfortable with A minus rated companies offering 5.7. That's a strong play when somebody's looking for a guaranteed rate of return.
Very good. Well, all right. So for our last article, speaking of insurance, so I just released report from LIMRA. What does LIMRA stand for?
Life Insurance Marketing Research Association.
Okay, very good. So a recent release report from LIMRA shows that life insurance demand has hit yet another record high, with total premiums up over 10% year over year. So this year compared to last year. There's an article on the Insurance Business Magazine. Yes, we are nerds. But this article breaks down the LIMRA report, and it's titled the same thing. It says, Life Insurance Demand Drives Record $17.5 billion in total insurance premium. Now, Jay, according to this article, of breaking down those different premiums amount, Index Universal Life was a major contributor to the overall growth of new premium at $4.5 billion of the $17.5, which, according to this article, is that 17% increase over last year. And also, according to this article, that is roughly 1/4 of the total life insurance market. Whole life saw a 7% gain. And then variable universal life, or VUL, jumped 17%. And I'm going to be honest with you, Jay, I didn't think VULs were still a thing. I mean, I've been so far out of the broker world. So the point being with all these ULs and VULs and all that, can you help our listeners understand these different types of life insurances and why people are buying them in record amounts to date?
So I was familiar with this article when the actual report came out because LIMRA sends those reports to me directly.
I figured you got it directly, yeah.
Now, this just happens to be an article that summarizes the report.
Yes,
so
for guys like me.
It's actually the 4th out of the 5th year that we've had a growth.
That's what I thought.
And I could have told you this based on the experience that we are seeing, that I am seeing it at our agency just here along the Gulf Coast, and agents and advisors that are doing business with us helping their clients. Now, the reason it is and I'll be quick, the reason it's important is because I said it earlier in the show, millennials and Gen Z understand the importance of protection. Then they come in there and they want to get educated. Hey, teach me about the different types of insurance that are out there. Let me make an educated decision on what fits my family, my business, my situation the best. There's term insurance. There's whole life insurance. There's universal life insurance. Those are the 3 basic types. Mm-hmm. Now, everybody understands term, 10, 15, 20, 30-year term. Term is guaranteed. The premium's guaranteed. The death benefit's there. Everybody should understand what a whole life is. It's guaranteed death benefit for your whole life. It's designed to be there the day you die. And then universal life, because whole life has some constrictions and restrictions to it, universal life is called flexible life insurance policy. You can skip a premium, you can raise and lower your premiums that you put into it, and that will have an impact on the cash value accumulation that is created inside the policy. All 3 types are very, very understandable, but when somebody says, well, Josh, I don't want whole life because I want to maybe have some market participation.
Yeah.
Then we go to variable or we go to indexed.
Okay.
I understand the market participation, but I don't want to lose any of my cash value if there's a downturn in the market in my life insurance policy. So that'll take variable off the table and insert index.
Because variable actually invests directly into the market.
It's directly into sub-accounts, mutual fund type, and sub-accounts of your, so whatever's after the cost of the insurance, the equity in the contract, you've made a decision with somebody like yourself, Josh, on where you're allocated in your cash value opportunity growth.
Understood.
Goes up and down with the market just like a mutual fund would.
Okay.
If somebody says, well, I don't want that in my life insurance, I want that opportunity, let's go into an indexed universal life. It matches or mirrors or rides an index like the S&P or the Dow or some combination thereof, and it allows for a 0% floor, so you're never going to lose any of your cash value. You will have cost of insurance, so there is some expenses there.
Right.
But on the upside, the index says you can participate in the upside. So there's term, whole, universal, and in universal there's variable and there's indexed. All of them have been buoyed, meaning increased in premiums and purchasing over the last 5 years by the sheer fact that it's easier to get life insurance. The processes like we talked about in the beginning, technologies, insurance companies being a little bit more lenient on risk, and then the consumer is understanding the importance of having it.
Very good. Way to stick the landing there, buddy. All right, so listeners, if you want to set up a follow-up conversation with us at Gulf Coast Financial Advisors, you can give us a call, 251-327-2124, or go to our website, gulfcoastfa.com. On the site, upper right-hand corner is a blue button that will put something on my calendar. That can be a 15-minute phone call, 30-minute Zoom, or honestly, let's just meet in person. Any of our 3 office locations are very convenient. Downtown Fairhope. Also have one down in Orange Beach. We're just down the road from the wharf. And we're also in Mobile near the intersection of Dolphin Street and I-65. Make sure you reach out to us. All right, folks, coming up next, Josh's Crystal Ball and Big Mouth. Would have been some of my predictions. Have I been right? Was I ever wrong? What do I think is going to affect investors in the near future, maybe the distant future? We're going to talk about that, and we're actually going to, this one's going to be pretty important because we're going to chop up something that is really top of mind. And we want you all to stay tuned. Whether it's building a business from scratch with your own 2 hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's Gulf, like the Gulf of Mexico, Coast, FA as in financialadvisor.com. Welcome back. Your host, Josh Knoll, here alongside guest co-host Jay Stubbs of Providence Partners. So Jay and I, we are opinionated. We have strong opinions. I've known Jay long enough to say that. I hold out that a radio show host that doesn't have an opinion would be very dull to listen to. Jay and I are paid in our respective professions to offer professional guidance and opinions to our clients. Otherwise, this replaces us with AI, which is what we're going to talk about.
Oh, no.
Yeah, all right. Let's get out with Josh's crystal ball. So here's the setup, Jay. My middle son asked me the other day, I'll make this brief. He asked me, Dad, is your job going to get replaced by artificial intelligence? And I said, son, that's something I think about every day. So what I wanted to do, Jay, is throw it out there. We're going to give our opinion and give some predictions around the impact of artificial intelligence, kind of on our jobs to some degree, but related. What say you? I'll ask you. What do you think? You think we're doomed, or we think we're going to stick around for a while? What do you think?
Fortunately, Josh, you and I, and hopefully a lot of other financial advisors in our marketplace have built a consultant's relationship with their client base, meaning the situations that are brought to us day in and day out need thoughtful conversation. They need education on concept. How does this work? How does that work? What about this? What about that? There's emotions that come into play when people talking about their money and their investing, the risk management components. There's always going to be an answer online. There's always the internet, Josh. The internet it's provided answers for decades.
Right.
AI is just making it easier and more thoughtful and predictive for us to be able to give more dynamic answers, questions to tax-specific situations, questions on how would this affect my portfolio, but there's still going to be that consultative approach that is needed. So, fortunately, you, me, and a lot of financial advisors that we're friends with and colleagues with, it'll be important because yes, the millennial, the Gen Z person who doesn't want to deal with a financial advisor says, I'll just do this on my own.
Sure.
Goes to a platform, says that they want to find the best 5 ETFs based on performance for the last 10 years. They can narrow that list down. They can immediately plop in. They can model how much they want to put in a month or a year. All of that can be done through AI and technologies that is amazing. But then when the rubber meets the road, what if volatility strikes? What if a client event occurs, a negative client event, death, disability, onset of an illness of a family member, new job, lose a job? All these things that take an emotional wear and tear, positive or negative, are going to need to have a sit down with a conversation with a financial advisor. And I take 100% of that and feel good about it, because that's just what we do.
Yeah, AI has never navigated a divorce, as far as I know, and and I have, unfortunately. But and Jay, for me personally, I'm not. I mean, obviously, you and I have been around long enough that, one time 10 years ago, robo-advisors was supposed to wipe us out, right?
Oh, yeah.
Now, AI is obviously a much different and more dynamic animal than robo-advisors, the Betterments of the world, which are still here and doing well, but they didn't consume the industry like there was once feared. But for us, we embrace technology. So I've used AI. Heck, I used it to prepare this outline, and I'm naturally a consensus builder anyway. So if you were to ask me what is my ideal work environment, it would be working at my desk and having the 5 to 6 people I trust the most in the different industries sitting there to answer my questions.
Right.
Well, AI lets me do that to some degree. It allows me to build consensus with the understanding that some of the consensus I'm getting is the average opinion.
Right.
Right. And so what I tell people is, for now, and this could change, but if you're looking for the average advice, the average opinion, the average experience, and all that, AI is going to give you that average. Fantastic. I mean, the data pool's exceptional. But if you're looking for something where the advice is as unique as the life that you have lived, then you're still going to need a human being, man.
Yeah, I don't necessarily want the answer the fastest, and it's the fastest time to get to me, and it's the average answer.
That's the average answer.
Give me the best answer that fits my unique situation.
Right, yep.
That's what I want.
Combine the math with the life experience, and off you go. Well, we shall see, buddy. All right. Well, listeners, I hope you enjoyed a little behind the scenes on how Jay and I form our opinions. We invite you one last time to reach out to us. You can call us at 251-327-2124 or go to the website, gulfcoastfa.com. Again, one last time, up on the upper right-hand corner, there is something that we'll put a meeting on our calendar. And also, one quick note, don't forget to vote in the Nappies. The local weekly Lagniappe has got the Nappies going on, and we are trying to win the best lifestyle radio show. So put us in there. And also, don't forget to visit the website and go to Jay Stubbs' personal profile, and I will have the Ethos link for those of y'all that are interested in looking at life insurance again, or maybe even for the first time. Check it out. Go down that road. And remember, both of us are always a phone call away if you want to have a personal or human interaction with that. So very good. All right, folks, well, that is it for this week. I want to give a huge thank you to my returning guest co-host, Jay Stubbs, and also for sponsoring the show. Thank you very much, your Business Providence partners. Thank you to our awesome radio station. That's FM Talk 106.5 out of Mobile. Thank you to the provider of our show music. That is local band Sloth Racer. Huge thank you to the show producer. That is my son, Peyton Null, War Eagle. And as always, my sincere appreciation for all of you out there that have been listening and joining Jay and I on this journey. We'd love to be a part of your journey as well. Till we talk again, have a wonderful and productive week. This has been Coasting in Retirement with Josh Null. Gulf Coast Financial Advisors, LLC, known as GCFA, is a registered investment advisor offering advisory services in the state of Alabama and in such other jurisdictions where it is registered, filed the required notices, or is otherwise excluded or exempted from such registration and or notice filing requirements. Registration does not indicate or imply that GCFA has attained a particular level of skill or ability, nor does it constitute an endorsement of the firm by the Securities and Exchange Commission, the SEC, or any other state securities regulator. The Coasting in Retirement radio program serves mainly to disseminate general information, including those pertaining to GCFA's advisory services, together with access to additional investment-related information, publications, materials, and links. The publication of this radio show should not be construed by any client and or prospective client as GCFA's solicitation to effect or attempt to effect transactions in securities, nor should be interpreted as GCFA providing personalized investment advice or any type of professional advice for compensation wherever this program is broadcast. Any subsequent direct communication by GCFA with a prospective client will be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. Certain information, news stories, headlines, data, charts, graphs, figures, or statistics presented on this radio program may have been obtained from third-party sources that are believed to be generally reliable, but which GCFA may not have independently verified. GCFA does not and cannot guarantee the timeliness, accuracy, or reliability of any such third-party information and undertakes no obligation to update or correct any information that may become obsolete, unreliable, or inaccurate. This radio program also contains the opinions, views, and perspectives expressed by Josh Knoll and any other GCFA representative, which are solely their own and do not necessarily reflect the opinions, views, or perspectives of GCFA as a firm. Such personal views and opinions should not be construed as endorsements or professional advice from GCFA. GCFA makes no representation or warranty regarding the accuracy, completeness, or reliability of any information on this radio program and disclaims any liability for any direct or indirect loss or damage incurred from using or relying on such information. GCFA and Providence Partners are not affiliated, nor are any of their respective representatives.